Hi guys, so today we are starting off with throughput accounting. Now, before I start writing the notes, let me give you a bit of an overview about what throughput accounting is. Throughput accounting basically is a modern technique of dealing with overheads. But by overheads, what do I mean? And in relation to this technique, what was the older technique? So, marginal costing was the older technique of this, and throughput accounting is the newer technique. Now, by overheads, what do I mean? This technique basically looks into account the limiting factors, and it deals with limiting factors. What are the limiting factors? Limiting factors are all those factors that limit your activities, limit your company's activities. For example, let's say if demand is limited, then limiting factor becomes demand. If let's say labor hours are limited, then labor hours become the limiting factor. Okay, so these limiting factors are also called the bottleneck resources. So you might see interchangeable terms during your exam format or when you're looking through the past papers. Let's start writing the notes, and I hope you guys will be copying it. Now, I have written the notes. I want you guys to copy it down. But currently, we just discussed the definition of what throughput accounting is, right? So let's take it a bit further. Now, when you're working on throughput accounting, your formula changes a bit. Previously, in marginal costing, what was happening was that you had to compute the contribution through selling price minus variable cost. That was your formula of contribution, right? But throughput accounting says that in today's world, only material cost is the variable cost. Labor overheads, labor wages and other overheads are considered to be fixed costs. Why? Because if you go back 10 years, there were a lot of people that were being paid hourly wages. But in today's world, majority of the people are paid a fixed salary, right? So even though there may be a lot of people that are still receiving salaries in an hourly manner or according to per unit, but for the companies, they consider it as budgeted overhead, and when you consider it as a budgeted overhead, you basically are giving it the importance of kind of a fixed cost, right? Because you're already focusing on it while budgeting. You're already saying that okay, around 1 lakh rupees is going to go out in salaries, let's say, just giving you an example. So you consider it as a fixed cost in your case, in your company's case, which is why throughput accounting says that marginal costing was different, and we have a new way to compute our contribution, and that is selling price minus material cost. They say that you only pay the supplier according to per unit, which is why the amount of materials, let's say if you're buying 5 kgs and each kg is of 200 rupees, so 5 multiplied by 200, whatever the total amount comes, that is around 1000 rupees, you are going to pay that accordingly. But if you reduce the amount of kgs, then your total material cost reduces as well. So they say that only material cost is considered to be variable. Other overheads such as, let's say, electricity expense, rental expense, gas bill, water bill, all of those are in today's world considered to be a fixed overhead, right? So they say that whenever you're going to compute the contribution, which is also called throughput, you will simply subtract selling price minus material cost. Now, what is the difference in computing marginal costing and computing throughput accounting? So, previously, the 5-step approach was that you are going to identify the limiting factor in case of marginal costing. Then you move towards calculating contribution per unit. Then you would calculate the contribution per limiting factor. Then you would rank your products and make an optimal plan. However, now what happens is that throughput accounting says labor and variable overheads should be treated as fixed cost. So our 5-step approach has changed a bit. How has it changed? Identify limiting factor, same step as marginal costing. Calculate throughput per unit. How will you calculate throughput per unit? Selling price minus material cost. Calculate throughput per limiting factor, then rank your products and then make optimal plan. Now, when you want to compute the profit under marginal costing, simply subtract contribution minus fixed cost, which is the general fixed cost, which is actually a fixed cost by nature, to get profit. But in throughput, you first compute the throughput, subtract your general fixed cost. What is general fixed cost? The fixed cost that was actually fixed by nature. And then other fixed cost. What are other fixed costs? Labor, wages plus variable overheads. And then you get your profit. I hope this makes sense. So this is how we are going to work on throughput accounting. Make sure you have copied everything. And in the next lecture, we are going to start off with the past papers and example questions of throughput accounting.